Hello, everyone. It's PJ Patterson, and this is a market update for the week that ended on the 1st of November. So today is actually the 2nd of November here in the United States. It's Saturday, and I'm heading home on Sunday, tomorrow, the 4th. I'll be back, the 3rd. I'll be back on the 5th on Melbourne Cup Day. So hopefully you've got Melbourne Cup Day plans I have no idea who's running in that race. I'm not a punter anyway, really myself, so hopefully you've got some work functions or something planned to enjoy a fantastic Melbourne Cup Day. It'll also be an interest rate decision day, so it'll be quite interesting to see what our Reserve Bank does this month with our interest rate settings. I'm going to talk today, top three things today are going to be the Fed rate decision that happened this past week. Secondly, China, the trade deal, and then this book that I'm reading about the stealth war that China is waging. Very interesting stuff there. And then finally, what looks to be a move back to Quad 3 for the U.S. and really the global economy, including Australia, and what that means for us as investors, and also looking at some inflation. So the first thing I want to touch on is the interest rate decision this week. So the Fed lowered interest rates by 25 basis points. I'm just showing you a quick chart here of the U.S. 2-year Treasury, and what you can see is that Treasury yields, and this is over a year. I'll just go to a 5-year time frame here. But as you can see, the U.S. Treasury yield, 2-year note, has been steadily falling since late 2008, when it was up around the 2.75, 3% range. It has steadily fallen, and I believe, and the data is suggesting, that it will continue to fall. The market is suggesting that it's going to continue to fall, even though the Fed, in its language this week, said that it was likely that it was going to be pausing, and they were going to be a bit more data dependent and that sort of thing. The market doesn't really believe that, and one of the main things, and I'll talk about this in a moment, is the things that are showing signs of inflation. The market is not believing that the Fed is done cutting interest rates, and it's also beginning to price in, it's looking like it's beginning to price in an expectation of further inflation coming through the system. So very interesting dynamic that we are currently in. What the Fed really needs to do, though, is to cut rates to weaken the U.S. dollar. And I'm just going to flip over to another chart, of the dollar index. This is a 1-year chart of the U.S. dollar index. And what you can really see here broadly is that the U.S. dollar has been pretty strong over the course of the last year. It's been rising. And this is an index. It's an index weighted against a basket of currencies. But, we had a bit of a drop this past sort of 2 weeks or so, with interest rate expectations dropping and interest rates actually dropping. But the Fed really needs to weaken the dollar even more. And it needs to weaken the dollar, the U.S. dollar that is, against a basket of currencies in order to make and to help the U.S. economic recovery. And basically what that means is that the dollar, a weakening dollar is good for U.S. exports. And the U.S. needs to increase its exports to drive GDP. That's one of the 4 things in the GDP calculation is net exports, is exports. And so this number needs to continue to drop. Now, one of the ways to drop that number, that dollar index, is to keep lowering interest rates. So very interesting dynamic, as I just said. I'm gonna continue to be watching for further interest rate cuts. The market is going to lead the Fed. The Fed does not lead the market. The Fed thinks it leads the market, but the Fed always reacts to what's going on in the market, and the market knows better than the Fed. This is just something that is pretty much always been the case. Somehow the market knows. The market is an incredibly large, complex beast, but it seems to know and anticipates what is going to occur. And I'm going to talk a bit more about that when I talk a little bit more about inflation. So again, to cap off the interest rate thing, we're going to continue to see all the interest rate investments that I've made. So this is fixed income stuff. This is the zeros. This is the TLT holding. This is all the things across the curve in the U.S. that we want to own. Hybrid as well in Australia. we should continue to see performance and outperformance from our interest rate sensitive investments. That's UTEs, that's utilities, real estate investment trusts, etc. We probably have another quarter-ish of this before we need to start repositioning for additional growth and inflation. Now, I'm just going to pivot over to our second point today, which is China and this supposed trade deal. What's interesting about China is, and I'm reading this book, Stealth War. I'll just show you real quick. Stealth War by General Robert Spalding. He's retired brigadier general from the U.S. Air Force. Spent a lot of time living in China, studying China. He was the top-ranking advisor to the Joint Chiefs of Staff in the U.S. on China. It sounds like, and from reading this book, this guy understands China back to front. I'm only about a quarter of the way through the book, but it is really a page-turner, and it is demonstrating to me and educating me on what China is really up to. So a couple of key things that I want to just point out about China. First of all, it's a totalitarian regime. It is a command and control economy, and the CCP, the Chinese Communist Party, controls everything. And I mean, they control everything. Their human rights are horrendous. The way they run the country is by direct control. The CCP has party members on boards of committees of companies. They can basically do whatever they want. There is no rule of law there, really. I mean, there are laws, obviously, but they can change those at will, and they do. And the reason I'm saying this stuff is because I've got to admit that I did not realize how dangerous China actually is to Western democracy, and with what they're doing and trying to do around the world, I have a deep level of concern as an Australian and as an American, but specifically as an Australian because that's where I live, about our food security, about our energy security, about Chinese ownership, foreign asset, owning Australian assets. And I dare say that our government's probably asleep at the wheel on this stuff. And one of the things that, if you're watching any of the media, you're paying attention to the news, we've begun to see these stories percolating around influential Chinese people in Australia getting caught out for making political donations and all this sort of stuff. And this is what they do. They infiltrate other countries. They get influence and they usually buy it by making investments and then, throwing money around and this sort of thing. And they get everybody all warm and fuzzy about China. But the reality is China is literally waging, and the title of the book is appropriate, Stealth War. They're literally waging a stealth war because they don't want to have to fight a real war. Now, this is what America knows, right? America knows if we're attacked, we're going to go fight. Like, that's the American way, right, is to go and drop bombs and shoot people. China does not want to do that. They are not interested in firing any shots at anyone or getting involved in a war because they would most likely come up against, the mightiest military in the world, which is currently the United States military. And they don't want to do that because they'll get their butts kicked most likely. And of course, they'll have tremendous casualty, destruction of property, everything else. So what they do is, as I was just describing, is they infiltrate countries and they try to influence. So one of the issues that we currently have with China, and I'll touch on this and then I'll move on to Quad 3 and inflation. One of the issues we have currently with China is that they have a US dollar liquidity issue. So China has what's called a closed capital account. In other words, if I was a business in Australia and I wanted to open a similar business or that business in China, they would probably let me do that. And if I made an investment in China, China has a closed capital account. So if I put money into China, I cannot get it out. They do not allow that. Now, there are some circumstances where they do, and that take special influence and stuff. And I dare say you'd have to be a member of the Chinese Communist Party, and you probably have to be very influential in there to get that capital return. But the issue is this. There are a whole bunch of U.S. businesses, probably Australian businesses as well, that have made investments in China thinking, if we do this, we will democratize these people and this government and this regime. That ain't the case, ladies and gentlemen. In fact, China, will probably, unless there is some sort of massive revolution there, which is something that they are very, very afraid of, we will not see any real meaningful democratic initiatives in that country. And so just to close off the capital account thing, this is why I will never, ever now invest in China. I will never do it because unless and until they open up their capital account. And the reason for that is money goes in, money doesn't come back out. They control that flow. So there's a lot of companies with assets in China on their balance sheets and cash on their balance sheets that's domiciled in China that they're never going to get out of China. So you might as well just write that investment off because China literally could snap their fingers and grab all of that cash, grab all of it, shut all those companies down, and be like, "Screw you, you're done, you're out, that's it." And there are actually precedents for that in very small circumstances. But could you imagine if they did that to someone like Apple or Microsoft or any large, manufacturing business that was over there, one of the car manufacturers or something? Very, very scary stuff. So what I'm about to get into with this book is how the Chinese economy is run and how that is how they sort of are waging this economic stealth war. So I'll keep you posted on that because I think there's some very big concerns, and China is now a huge player in the global stage. They're the second largest economy in the world. And their banking system is in really, really bad shape. They have a tremendous amount of debt, about 4 or 5 times the amount of debt on their bank balance sheets than we have in the United States, and that's probably 20 or 30 times what we have in Australia. So China is often an area where Australia goes, whatever happens in China, that's going to impact Australia, and I broadly do believe that. There's some stuff that I'm beginning to see now out there about China having a resurgence of buying raw materials and this sort of thing from Australia. I cannot see how that's going to happen, especially. I'll just show you actually a couple of other screenshots here. Just to close off China, their manufacturing PMI is negative and continues to be negative, not negative, sorry, but below the 50 mark. So they're really showing that they are not recovering economically at all. Now, interestingly, this is the China manufacturing PMI number that was released last week at some stage, I think maybe Monday. And then they had another number that came out from the Caixin China's manufacturing PMI, and it was showing that it was above 50. So there's something wrong with these two numbers. This is sort of an official number that comes out from the PBOC. This one, I think, is more of a regional thing. But anyway, it just highlights the fact that, and I think I said this in my last update, that China cooks the books. The numbers that come out of China really cannot really be trusted. So who knows which one of these two is actually right. I'm going to suggest to you that that number is correct, and I'm going to utilize, as I've often discussed, we utilize things like Dr. Copper to tell us what's going on in the world and whether we are entering a global economic recovery. Now, this chart, once again, and I've talked about this chart before, copper is not signaling that we're going to have a global recovery of anything. In fact, copper has rolled back over in that little red bit. Copper, I think, closed the week at about $2.65 a pound, and so clearly copper has rolled over. Now, let's just move on to Quad 3 and inflation. As I segue into that, I have been discussing the S&P 500, sales and earnings. We have now seen earnings growth. We've got about a little bit, I guess that'd be almost 2/3 of the companies reporting, and we're just squeaking out a very minor positive number on earnings growth. So this was not really expected. Now, we'll see with the remaining 150-odd companies reporting what that does to earnings growth. But it looks like they might just squeak out a little bit of earnings growth. Now, this is typically going to have been now on revised numbers. So whether this is really real earnings growth or not, who knows. But the good news is that there's a little bit of earnings growth, but there are still some subsectors in the economy that are not doing well at all, including information technology, the financials, and energy and materials, which have just been completely hosed. So I just thought I'd mention that. Global data. I usually do touch on this. There's a lot of red in this chart. A lot of the PMIs, again, China's PMIs negative and continuing to fall. Hong Kong is technically now in recession. That place is absolutely screwed with all the riots and everything else. And there's a number of other reasonably, poor economic data points that have come out. France is really in deep doo-doo as well, with their GDP continuing to fall. So there's a number of economies around the world that just, big ones that aren't doing so well. Finally, let's just talk about inflation. And I want to show you a chart of the CRB index and what could be happening at the moment with inflation. So when we are in quad 3, that is a quad that typically you start to see some inflation coming back into the system. And again, we look at data, I look at data, and what this chart is showing you is that we're seeing a little bit of an uptick in this CRB index, and we've started to see that now since around August of this year, and it's just slowly been moving up. Now this, I would have to see this break out and move up into this, 190 to 200 area to start to really believe that we're going to have a confirming signal that inflation is on its way. So this could roll back over, but the projections are, and the data suggesting that we're really starting to see some inflation creeping back in. So what that means is I'm going to begin setting some inflation hedge investments to make sure that we are positioned to have the inflation trade on to take advantage of the likelihood that inflation will come back into the system. And if the Fed keeps cutting interest rates and they lower the US dollar, we will get inflation, because there's an inverse relationship between the US dollar and pretty much any commodity out there, including gold, oil, silver, all of the grains, etc. So I will be watching this index with great interest. That is really about it as far as a market update. We're still, I'm still anticipating that we could see a bit of a sell-off in the market, potentially in November. Honestly, I don't really know when it would occur. There'll probably be some data point or something that will trigger that. And it should most likely be around earnings, and then the realization that the growth and other stuff that's going on around the world is still pretty horrendous. So the market will have to reprice on that. Anyway, I hope you're having a fantastic weekend, and I will update you again next week from Australia. Have a good one.